Hello, my name is Lorenz Jüngling, and I'm the co-CEO of Moonfare and Steffen's partner. I will be covering for Steffen today, who unfortunately couldn't make it. Welcome to another edition of our Deal Talk series, where we interview some of the most prolific deal makers in private equity. In this episode, I have the enormous pleasure of introducing Dipanjan DJ Deb. DJ is a co-founder and CEO of Francisco Partners, one of the largest and most active technology-focused investment firms in the world. Francisco Partners has invested in or acquired over 400 technology companies, making it one of the most active and also long-standing investors in the technology industry. DJ, I've been following the growth of Francisco Partners for a while and can only admire the success of the firm, but also the vibrant company culture that DJ and his colleagues have built. We'll discuss all this and more in the next hour. At the end, there will be also the opportunity to ask questions to DJ. You can enter them in the chat and we will then read them out. DJ, you were 30 years old when you co-founded Francisco Partners in 1999, practically on the eve of the dot-com bubble. You left your job at investment giant TPG and took a risk in setting up a shop on your own. How do you remember that time? What drove you then? How was the experience? How did it shape you?
Lawrence, first of all, thank you for having me, and thank you for substituting in as well. Appreciate the time and appreciate the partnership with Moonfare. So I guess the benefit of being young when you're 30 is you don't actually think about the consequences. And so it seems a little crazy now, but I've always lived my life with the adage of you never want to regret not taking chances, because you never want to live life saying what if. And I saw something when I was young, which is like, why not you? Why not now? And I sort of lived with that proverb throughout my life. At the time, it was the late 90s, as you mentioned. We were in the middle of the dot-com bubble. I was at TPG with one other partner. TPG was a very small place, fantastic firm. We were responsible for all the technology investing, but we thought long-term that the tech industry, you needed to specialize to get differential returns. And that was really the vision of Francisco Partners, which is doing large-scale private equity, but focused on the technology industry. We felt that industry was really going to be a horizontal, not a vertical, and needed to specialize long-term to get differential returns. I would say I remember I just turned 30. We just bought our first house. We just had our first daughter. So when I told my parents that I was going to go a year without a salary, they thought I was insane. But I assured them that worst thing that could happen is that the firm wouldn't work and I would find another job. And, I had a great set of parents and we were very supportive, great wife, and allowed me to take.
That's an incredible story and really, really inspiring. Obviously, one of the questions that everyone will have is, when you look back, is there something you would have done differently? What would you say you've been most proud of in that journey? And what would you say to someone like yourself at that age as kind of like a suggestion of like what to focus on?
Well, the tale of Francisco Partners is really a revival, a resuscitation story. So we had a lot of success in our first fundraise. We raised almost $2 billion. And then we proceeded to basically become our business case study of what not to do. We lost almost $500 million in two of our first three investments. I would not recommend that, by the way, for folks that are starting firms. And candidly, we didn't know what we didn't know. We thought we were decent deal guys, and I think we started believing that a lot of our success was our own performance, but really was a run up in the late 90s. And we didn't put enough safeguards in place. Effectively, the pitfalls of Fund 1 gave me an opportunity. I took over running, one of my partners ran the firm. He was my boss at TPG from 99 to 05. I took over running our firm in 2005 and have been running the firm since 2006 effectively. And, we put a lot of safeguards in place, with the first safeguard being return of capital and then return on capital. We made three sets of changes that really have kind of been the vanguards of FP since then. The first was a focus on process. So it was not one or two things. It's literally 50 different things. Every partner has a business plan. Every deal gets reviewed at investment committee 3 times. Every CEO has to come in to present to the firm. All deal teams have 2 leads. Every portfolio company is reviewed once a month. Nothing that's blocking and tackling, but we thought the epiphany for us is, why aren't we running our business like we tell our CEOs to run their business? So that was the first step. The second step, I would say, was a focus on capital preservation, which is we focus on what are the downside cases and how do we not lose money as the first edict, and then how do you make money on top of that? And the third was a culture of spreading the wealth. We felt like if people at Francisco were going to be partners, we have over 100 people that have carried interest in the fund, they're going to act differently than their different employees. So when I took over running Francisco Partners, FP1 was below cost. It ultimately ended up being an okay fund, but not a great fund. We also recognize that whatever happened in the past doesn't matter. Investors only care about the future. So you're as good as your last fund and your last investment. And I'm sitting in my office in San Francisco, and that's number one edict on the wall.
Yes, I can definitely see that. And thank you very much for alluding so much on the process of how you turned this around and it becomes such a success. Obviously, what's interesting to everyone who is dialed in is not only kind of like from a process perspective, how did you build the firm and how did you become so successful, but also what would you say is the secret sauce for you in picking deals and executing them that makes Francisco Partners so different in their success from the rest of the industry?
Well, I would say a few things. First of all, we feel incredibly fortunate, and a lot of life is luck. And we happen to be in a lucky sector, which is technology. Technology is a sector that outgrows GDP by a factor of 2x. There's only been 5 down years in 55 years. And if you have a tailwind of technology, you're more likely to make money than if you're in another sector that's not tech. That's kind of step one. The second thing I would say is I have a great set of partners and people. We could talk about culture in a second. I think that's one of the questions you said you're going to ask me. But, there's another expression I sort of live by, which is vision without execution is hallucination. So vision is great, but if you don't execute, it doesn't matter. And the only way you execute is through a great set of employees, partners, et cetera. And I have a great set of partners. Everyone's entrepreneurial. If I had to start the firm, these are the same people I would start. And the last thing I would say is our strategy has not drifted. Many of our brethren have drifted strategies as they've gotten bigger or they've gotten FOMO or fear of missing out. Our strategy remains simple, which is it's called complexity arbitrage, which is you buy confusion, hopefully at a discount, and sell clarity, hopefully at a premium. What does that mean? It means buy companies that have good technology and good customer base, but that are not optimized. And you see that over and over and over again in technology, which is companies lose sight of what made them successful and chase growth at all costs and don't think through ROIC. And that's where we try to arbitrage that difference.
Look, that I've heard that phrase before, and I think it's a very memorable claim that you buy complexity and sell clarity. Generally speaking, it has not been so easy to be a technology investor over the last 18 months. Though if I hear your thesis, obviously it's something that should work very well in this environment. Is there anything that you did to adjust for the higher interest rate and the falling valuations currently?
So stepping back maybe 2.5 years ago, we have our advisory board meeting every March, and we have our annual meeting in October. In fact, we had our annual meeting 10 days ago. In March 2021, to start the annual meeting, I sort of give a state of the firm. In fact, my first comment is a little bit about what I see, and the second is all the 10 things we're doing well and how we can improve. But to get that conference started, I made a joke, which is I know more people that have raised a SPAC than have had COVID. And at the time, that was true. Of course, God was listening, and I got COVID 3 different times. But the epiphany for us is like, wow, if we're saying this, the markets must be crazy. And at the time, growth equity stocks were trading at 30 or 40 times revenue. And venture capitalists everywhere we're saying this time it's different. Every time we hear this time it's different, it's usually a sign of the market top. And the last happened in 99, 2000, or 07, 08, right before the great financial crisis. So we made 3 strategic directions at that time. One is trying to sell every company we could. 2 is buying companies that could withstand a duration and withstand a recession. Now, we didn't think Russia would invade Ukraine and we'd have all the supply chain shortages. And 3rd is we pulled fundraising in a year. In fact, we raised money in beginning of 2022. We closed in Q2 of 2022, but then didn't turn on the fund for almost a year because we thought valuations were not that interesting. Now, today, we actually think valuations are pretty interesting. You look at, if you strip out what happened in 2019, 2021, valuations are back to 2013 period. So we think that's interesting. And most people in our world, LPs, GPs, tend to overinvest at the top and underinvest at the bottom. If you have a contra-cyclical view, you tend to outperform. Okay. Now, that does not mean, by the way, that there aren't risks today. You pointed them out. Interest rates are higher. When interest rates go high, valuations theoretically should be lower. Terminal multiples should be lower. So I think it will be hard for us and other private equity firms to have the same returns they've had in the past when you had a free money decade. And even though I think we did a lot of things right, in 2021, 22, 23, we also made some mistakes. We should have sold all of our public positions. We probably shouldn't have bought some business in 2021. In retrospect, we overpaid for those assets. We're trying to learn from that. We think it's still an interesting time, but the geopolitical environment today is scary. And a lot of people think there's still a recession happening, even though we haven't seen it yet. And when the stimulus runs out, inflation is still reasonably high by historical standards. So there's definitely points of caution to it. But generally, we're leaning in today versus when we were a year and a half, 2 years ago.
You mentioned valuations, and I think that's a super interesting point these days, also when you look at deal activity. We are in an environment where buyers and sellers struggle to settle on a price. What have you been seeing on the ground? Have price expectations started to align? How has deal making in your space changed since the highs of 2020 and 2021, and how are you currently dealing with it?
Yeah, so I would say for the industry at large, and we just shared some slides with our investors last 10 days ago, the market is down tremendously in terms of deal activity. Both the M&A market and the private equity market were back to 10-year ago levels. We have been super active. We've made 8 investments this year. As I said, we're trying to take a counter-cyclical approach. The reason the market is down is a few things. One is earlier this year, you had the SVB collapse. You had what happened with First Republic, and the debt markets had shut down. You also had public stocks that had fallen a lot, and boards had not recalibrated this was a new world order. And then I think what we see happening in the venture world is a little kabuki theater, which is venture capitalists, growth equity firms don't want to take the medicine and write down their portfolios. And as long as they have cash, they can have suspended disbelief, and they'll keep playing for hope. So that's why you've seen less deal activity, but it is starting to pick up. The leverage markets have come back. I think a lot of buyers and sellers have recognized that they need to start transacting because this may be the new world order and things aren't just going to have a V-shaped recovery. I think people got seduced by what happened at the beginning of COVID when the markets fell down sharply and came back sharply. I think that's what people expected this time, and that's not the historic norm. It's much more likely a U than a V, and people are recalibrating today.
Absolutely. But exactly to that point, Moonfare recently conducted a survey among our investor community. And almost 80% of the respondents felt technology still has the greatest investment potential. What are your views on long-term investment potential of technology? What are you specifically seeing, or where are you specifically seeing the biggest opportunities in the next 5 years?
Yeah, so, I believe words are cheap, actions matter. And it's for us, we're putting $600 million of our own personal money in our set of funds because we believe it. And for me personally, I have almost double the pro rata versus my carry. Whatever the young people can't invest because they don't have the financial wherewithal of our firm, I take up the excess, and the senior partners take up the excess. So we believe in the technology. So couldn't technology returns go down because interest rates are higher? Yes. Could technology go down, returns go down because we may head into a recession? The answer is yes. Long term, however, what we are good at doing is fixing companies. It's the complexity arbitrage. We buy confusion and sell clarity. And if you keep doing that, you may get a lower terminal multiple, but you will make 2.5, 3 times your money. And technology is like the laws of physics. It's the laws of gravity. If technology can dislocate existing sectors, it will dislocate existing sectors. And people always ask me, do I have too much technology exposure? And I say, you don't have enough technology exposure. Technology is a horizontal. It is, whether it's government, aerospace, healthcare, fintech, consumer, security, technology is pervasive and will displace anything that was done by hand before.
Yeah. You said it now the second time. You buy complexity and you sell clarity. Out of interest for me personally, what are the biggest sources of complexity in the companies that you buy? Maybe I will learn something that I can also look at in Moonfare.
Well, I would say that there's complexity everywhere, but typically what we do, about 30 to 40% what we do is buying division carve-outs. So for instance, we bought the Weather Channel from IBM. We bought IBM's Watson Health business. We bought a division from Raytheon called ForcePoint, which is both a government and a commercial division. We bought a division from SAP called Libmos. We bought a division from CVS. So 30 to 40% is buying division carve-outs. These are all great companies, but these are non-strategic assets. And what we tell these companies is it's addition by subtraction. If you divest these divisions that are not getting energy, that are dilutive to your growth rate, your multiple will go up. So divest that to us. Another 30 to 40% is buying from founders. Again, tremendously talented founders, but all their nest egg is tied up in one asset. And we try to monetize their asset and we try to take care of their baby. We allow them the opportunity to roll 10, 20, 30, 50%. And we say, we're going to try to take your company to the promised land. And they, after a certain point, they're interested in money, but they're also interested in their legacy. And one of my partners made this analogy, which I love, which is when we try to buy these companies from division carve-outs and founders, we're trying to buy the living room in a house without being plaster. It's not buying the whole house. So they really care who the buyer is. So that's another 30, 40. About 10 to 15% is going privates. That market is becoming more robust as valuations have come down and corporate boards recognize that, it may not come back in the V shape as I was talking about before. And the last 5 to 10%, I know, by the way, it doesn't totally add to 100, but I'm giving ranges, is what I'll call structured deals. So we did a joint venture with Ericsson where we bought a little bit less than 20% of their communications asset because they wanted someone to help manage that. We partner with 5 healthcare plans in a software business called Ability. So we'll do structured deals with corporates, again, to unlock value. So that's where the sourcing comes from, and that's where we try to add complexity or try to create the clarity.
Yes, makes total sense. You've talked about public markets. We have seen signs that exit markets are picking up too. Just last month, Instacart went public, and there's a strong backlog of great businesses that were considering an IPO but decided to wait out the storm. How is exit activity looking from the perspective of your portfolio?
Yeah, I would say 2021, 2022 were the 3 best years of liquidity in the firm's history. 23 was not so good for the reasons you cited. The IPO market has effectively been moribund. It's just starting to revive. The IPO market is not a huge source of exits for us. We tend to sell to strategic or other folks. But the IPO market is a good forcing function because you can threaten the IPO market before you sell. I think you will start seeing more activity for a few reasons. I think the IPO market is going to slowly come back, but I think it's going to be slow. And those 4 IPOs you mentioned, Instacart, et cetera, they've done okay, not amazing. Okay. I think you'll start seeing sponsor activity, and I think you'll see strategic activity because people are like, yeah, I think this is the new baseline. I'd say the wild card is just a geopolitical situation today. And I think people are going to taking a little bit of pause to figure out how things are going to shake out before they do more. But you're starting to see some strategic activity and sponsor activity. And for sponsors, they create liquidity or try to create liquidity whenever they're fundraising. So that when they need to fundraise, they will sell companies. They've held off on that, but I think you'll start seeing that.
Very, very interesting. We will see what the future holds. One thing that is the talk of the town these days is AI. It's, of course, a huge investment theme today. You can read about it in every publication. How are you, as one of the most successful technology investors, thinking about AI in your portfolio and for your firm? Can AI make private equity firms more efficient and better? And if yes, how?
Yeah. So those are all great questions. I would say, first of all, we are second derivative investors, not first derivative investors. It's a very important distinction. So the venture capitalists are first derivative investors, and they try to figure out who the next great AI companies are. We try to figure out how will AI impact the technology industry and how do we play on that. I do think the AI wave is a seismic wave. It's similar to the advent of the internet, which happened when I was starting in business school, and then kind of the adoption of mobile. But with all these things, they tends to be, it will be up and to the right, but it will not be uniformly up and to the right. You'll see one of these along the way, and there will be lots of shakeouts. From Francisco Partners' perspective, we look at AI 3 different ways. The first is how, with every new investment in every portfolio company, our first question we ask is, can AI dislocate what we're doing? How bad is bad? So you want to make sure it said, how do we preserve capital? So that's the first question. So we have a bunch of AI experts that look at every one of our investments in every portfolio company and say, okay, what do we need to do to make sure we're not on the wrong side of Clayton Christensen, famous Harvard professor's curve? So that's number one. Number 2 is then how can AI be useful? I talked about the laws of physics and the laws of technology. AI is the same way. With many, many of these companies, it will unfortunately dislocate jobs, but save companies. That's the second way. The third way for us is, as a second derivative, is how do we make investments in AI? And I think that's further down the line for us, because you will see that, up and to the right, lots of destruction with the VC and the growth equity community. When things become more mature, becomes more conducive for people like us.
Interesting. One thing I love about Francisco Partners is your operational focus. You have an amazing team of former CEOs and other C-level executives within your operating team. Could you shed some light on how they specifically support your business while ensuring you're not interfering with the autonomy of the entrepreneurs and founders who are actually running the business?
Yeah, a very good question. So we realized a long time ago that the best way for us to make money as our business became more and more competitive is actually to transform the businesses. As things become more competitive, you can buy cheaper than you did 15, 20 years ago, right? It becomes more expensive to buy per company, so you need to do something. We also thought the right way to improve companies was not to hire consultants. By the way, I worked at a consulting firm, and I was a 26-year-old regurgitating Gartner slides. We didn't think that was the best way to add value. So we have a team of now almost 50 people. They're all doers. They're not opiners. At our firm, I say this, like, if you come in my office and you ask me, what should I be doing? My immediate thought bubble is, you're not the right person. I want people who are doers versus opiners. And we have ex-CEOs, ex-CFOs, ex-VPs of procurement, ex-R&D folks, ex-functional experts. And they help us when we're doing a diligence on a company. They work side by side with the investment team. And then when we buy a business, we parachute them in to run a business until we can get permanent, the permanent. That's what's created the returns for us, is kind of the marriage of our operating group called FP Consulting and our investment team. Unlike other firms, they're not second-class citizens. They're kind of, side by side on every new investment in every portfolio company. And frankly, they tell us, like, no, this looks good on paper, but it's not practical. Or conversely, what you guys are modeling, you could do a lot more with it because they've actually run companies. Every one of these people has either run a company or have been the lead interface, whatever the functional areas at those companies have been. So they add tremendous value to us.
Yeah. So I was a consultant myself before I joined the startup circuit, and I have to say it's a completely different thing to be in training, so to speak, when you do consulting or run a live fire exercise. Yeah, like there's no comparison.
Well, I was a consultant at a very well-known firm, which apparently this is being recorded, so I won't say. And you have tremendously smart people at these firms, and I learned a lot. The problem is that, our business is not about opining. Like, we have an investment committee and everyone gives an opinion, and then I say, and what is the down arrow? Like, you can say all the positives, you can say all the negatives, but ultimately we have to make decisions, and that's what we have our operating group to help us do.
Yes, no, absolutely. Look, you said it. Our business is not about opining. Our business is about taking calculated risks, and sometimes the bets we take don't turn the way we have wished for. You've alluded to it a little bit in the beginning, but I would want to understand it a bit more. How did you as a firm and also personally learned to cope with business failures?
Yeah, so there's been a lot of failures. We actually, as a firm, have a culture where everyone gets a 360 review every year, and everyone at the firm fills it out for me as well as every other partner. And I let my wife read it, and she's like, "Oh my God, I can't believe people are writing this about you." But that's the only way you get that, right? And so even at our investor conference 2 weeks ago, my second slide was, "Here's the top 10 things we did wrong, and what are we going to try to learn from it?" Now, the reality is, you're not going to fix everything. Okay. And you have to recognize what's even feasible to fix. And if you try to fix 10 things, what'll happen is you'll fix none. You have to say, of those 10, what are the 3 things I really, really need to fix? And so really focus and having clarity of mission is the way to get improved at anything. The other thing I think we have gotten good at, we also realize not everyone is good at everything. When we started in this business, each partner was responsible for sourcing, for kind of the prosecution of the portfolio and selling. And we realized is different partners are good at different things. So we should put them in position of where they're strong. And so we try to leverage everyone's strengths, recognizing all of us have weaknesses. Everyone works on their weaknesses. I actually think the opposite thing is more important, which is focus on what you're good at and what you're passionate about, and try not to be in situations where you show your weaknesses.
DJ, Francisco Partners corporate culture is something that I've often heard people talk about. Yeah? You take your job seriously, but not yourselves. How else do you define your culture? How has that culture played into your success? Give us a little bit more of detail here.
Yeah. So I'd say a few things. I call it RHTM, which it starts with returns. Okay. Like the top 10 priorities I put in front of our LPs is returns. Like none of us matters unless you have world-class returns. And, cultures are better when you win. I've been on both sides of this. We almost went out of business in 2006. We're probably 1 hour away from going out of business. You can have a great culture. It doesn't matter if you don't win. So it has to start with, we have to do what's best for our investors, full stop. Okay. And our stakeholders. But then I called it HTM, which is humility, transparency, meritocracy. And those are kind of the 3 words we live by, which is years ago, one of my business mentors drew me a 2x2 matrix. He said, try to be in the top right-hand matrix, which is to have great performance with humility. What you don't want is the bottom, which is not good performance and arrogance. So there are a lot of arrogant people in our industry. So we take our job seriously, but we don't take ourselves seriously. Like everyone makes fun of each other. When I show up at work, I wanted to think about like what it was like in college, where you're really happy to see all your friends, where you make fun of each other in a lovable way, where people, and nothing is sacred. So I'd say it starts with humility. It starts with the rule that everyone treats an assistant as well as they treat every partner. If they're not doing that, they're probably survive and they don't have a place in our firm. Then it's transparency, which is we don't believe the senior person's ideas are the best ideas. We want the best ideas to win. On every investment decision, we start with the young people first. What do you think? And it's totally okay. It's totally okay to disagree with a partner. In fact, I have a senior partner today who, when he was an associate 3 months into the job, wrote me a long email saying our investor conference sucks. He was 3 months into the job. And you might think that's shocking, but I sat down with him. He'd come from another firm. And, I agreed with 60% of what he said, and we changed those things. But that became kind of an example of the firm culture, which is someone 3 months into the job can tell the CEO that the investor conference sucked. And we have hundreds of those examples where young people can say, this doesn't make sense. We just want to get to the right decision. It's not whose decision, whose idea it was. It was just the best idea. And then the last thing is meritocracy. So both my parents taught in college, and in the U.S. academic system, you have tenure. I think tenure is corrosive in our industry. And what happens at most other investment firms is the people at the top stop working and get complacent and aggrandize themselves with all the economics. And we never want a culture of that. So, one of my top 10 rules is there's no tenure at Francisco Partners. You're as good as your last investment. You're as good as your last fund. And in fact, I put up a Vincent van Gogh quote last week, which is all the little things is what leads to greatness. And you can never take any little thing for granted, and you have to do every little thing to make sure you stay at it.
Fantastic. Yeah, I completely agree with everything that you said. One final question from my end before we talk about the questions that were submitted. Moonfare is about democratizing private equity. So we have always a lot of first-time investors. In these days of confusion, what is the things that you would pass as knowledge to someone who is about to embark on the journey to invest in private equity?
Yeah, if you're gonna invest in private equity, I would say make sure you take a long-term view and don't panic. The worst thing people can do is put money into the top and then take it out when things hit bottom, because there will be fits and starts along the way. You know, you have to take a long-term view to equities. I think equities are still long-term the best asset class. I think technology is the best asset class within equities, but there will be fits and starts. So don't put in something that you need. Put in something that you think remember, it's illiquid and it could take a decade, but it will compound your wealth. But when you make that decision, think North Pole, right? We may go northwest versus true north, but eventually going northwest is better than not investing. And what individual investors often do is they get caught up with FOMO and they read what's hot and then they invest behind what's hot. Francisco Partners, I view is the lower beta way of playing technology, which is we will benefit from the tailwinds of technology, and which is the best tailwind there is out there. But what we do is fix companies, and that will never go out of style because companies are historically mismanaged, and you can find that in any environment. But you have to be patient. You have to be patient to come into Francisco Partners. You have to be patient if you want to come into private equity, and you have to say, like, I've picked North Pole. We're headed there. It just may go like this along the way, but 10 years from now, it's going to be the best asset class long term.
Great advice. Great advice. Thank you very much. First question. I'm an investor in FP7. It feels like it has had a slow start. Can you please comment on that and provide an update on perhaps some guidance?
Yeah, I think slow start is the wrong word. We did not invest for a year after we raised. In fact, what we told our LPs was we're raising money even though we're 50-60% invested in the prior fund, because we're raising money before the markets go down. And by the way, the markets did go down. So it turned out we were right. And we didn't think valuations were appropriate. And so we just waited versus just deploying dollars for the sake of deploying dollars. We started deploying dollars at this point. We're now about 16% invested. So which is, we think, right on track. And which view our job is to be the stewards of your capital and not do something just because we have the money. So I don't think it's a slow start in the sense that the companies are all performing, but it took us almost a year before we started.
Perfect. Can you tell us more about the competition you see at the moment? How has it changed over the years, and who do you consider as your main competitors in the space?
Yeah, there's a famous quote from Franklin Delano Roosevelt, which is never underestimate the man who overestimates himself. And that's how I view competition. So I would say, like, is there competition today? Yes. I would think a lot, I would encourage you to think of it as 4 really different vectors, which is software, scale, recurring revenue, and good CEOs. If you have scale software company with a great CEO and it's growing nicely, you have 30 competitors. As you relax each of those levers, you get less and less competition. So if you have to make a CEO change, you get less competition. If the company's growth is stalled, you get less competition. If it's not software, we invest in 10 different verticals within technology. It's healthcare, pharmaceutical IT, non-pharmaceutical IT, consumer internet, communications, semis, education technology, fin technology, et cetera. So as we look at all those sectors, you have much less competition in many of those sectors in pure application software, which tends to be the most competitive. In Europe, we tend to have more country-specific competition than in the States, but we really think about it as 4 levers. And look, it's not a zero-sum game. Many of our competitors will also make money. Hopefully, we will do better than them, but it's not a zero-sum game. I think there's a lot of technology. it's a startling statistic in the Russell 2000 IT index. 55% of the companies trade less than 3 times revenue. 75% of the companies traded 5 times revenue. So it's a large pond with lots of fish. So all these firms can be successful.
Yes. Last question from the audience is, what is the next steps for Francisco Partners? Other product lines, strategies? Will you even consider go public?
Yeah, so we will not consider going public. And right,
I would have not expected that.
Yeah, life is too short. And right now we have no desire to expand our product lines. We have a credit fund, and we obviously have our agility funds already. The agility is for our small market vehicle, which we raise simultaneously with our main fund. And we have a credit product line, which we're investing on our credit 1 and credit 2. So we'll continue along those 3 business axes. But at this point, kind of there's a maniacal focus on just doing what we're doing well, and to have the same returns in the FP5, FP6, FP7 that we did in FP3 and 4, and Agility 1, which were top decile performers.
DJ, thank you very much for having spent the time with us. I personally found it super nice to to get all of the insights that you had and like really get to know you. I think it was tremendous what you had as a success with Francisco Partners. It is absolutely stunning to see where you're heading going forward. And we are very, very excited to have you as a partner and on the platform.
Well, Lorenz, thank you for giving me the opportunity. Thank you for your partnership, and really appreciate you subbing in. You always did a great job, and appreciate all the insightful questions.
Thank you very, very much, and have a good day.
And thank you for all the investors who invested through your platform. We will, I don't know if we'll be the best, but we'll work 24/7 to try to make that happen.
I'm sure you will do that. Thank you.
Take care.